Hey there, investors. Welcome to the exciting world of the stock market. Today, we're diving deep into how economic events shake things up and create those winning or sometimes losing moves. Get ready to level up your investing game. We're going to break down complex economic jargon into bite-sized pieces. We'll explore the ins and outs of government policies, inflation rates, interest rates, and the global forces impacting our favorite Indian stocks. Let's dive in. The stock market doesn't exist in a vacuum. It's driven by a powerful engine, the economy. Think of it like this. The economy is like the engine of a car, and the stock market is the speedometer. When the economy revs up, the market usually follows suit. But why? Economic events directly impact the performance of companies, and those companies are the heart and soul of the stock market. When the economy is booming, businesses thrive, their profits soar, and investors get excited. This excitement translates into higher demand for stocks, pushing those prices up. But a sputtering economy can spell trouble, dragging down company profits and sending stock prices tumbling. Think government policies, inflation rates, interest rate changes, and those global market tremors. Buckle up, because things are about to get interesting. Governments play a powerful role in shaping the economic landscape, and their policies can send shockwaves through the stock market. Think of the government as a driver, with their policies acting as the steering wheel, guiding the economy and consequently the stock market. Take the Indian government's 2020 Union Budget, for example. It focused heavily on infrastructure development, which sent a jolt of excitement through companies like Larsen & Toubro and Ultratech Cement. These companies are major players in the infrastructure sector, and the government's focus on infrastructure meant more contracts and higher potential profits for them. The stock market loves good news and the prospect of fatter profits. So, naturally, investors cheered, snapping up shares of L&T and Ultratech Cement, driving their prices upward. But remember, not all policies are created equal. Stay informed about government policies and analyze their potential impact on different industries and companies before making those investment decisions. Inflation, that sneaky villain, can erode your purchasing power and play havoc with your stock market returns. Imagine inflation as a silent thief, slowly chipping away at the value of your hard-earned money. When inflation rears its ugly head, prices of goods and services go up. This means your money buys less than it did before. Now, how does this impact the stock market? Well, rising inflation forces companies to raise their prices to maintain their profit margins. Sometimes these price hikes are welcomed by investors, signaling a strong pricing power for the company. But if inflation surges too high, it can spook consumers, forcing them to tighten their purse strings. This drop in consumer spending can hurt company profits, causing their stock prices to take a hit. Let's rewind to 2021 in India. Inflation was on a tear, particularly impacting the prices of food and fuel. This had a ripple effect on various sectors. Keep a close eye on inflation trends and analyze how they might impact your investments, especially those in sectors sensitive to price fluctuations. Interest rates, those mysterious figures set by the Reserve Bank of India, wield significant influence over the stock market. Think of the RBI as a conductor, using interest rates as a lever to control the flow of money or liquidity in the economy. When the RBI raises interest rates, it becomes more expensive for businesses to borrow money. This can slow down economic growth as companies may postpone expansion plans or reduce investments. Consequently, investors become wary, anticipating lower profits, leading to a decline in stock prices. Conversely, when the RBI slashes interest rates, borrowing becomes cheaper, fueling business expansion, boosting economic activity, and often sending stock prices soaring. Remember the COVID-19 pandemic in 2020? The Indian economy was in a tailspin. To cushion the blow, the RBI stepped in, slashing interest rates to historic lows. This move made it cheaper for businesses to borrow, providing a much-needed lifeline during those uncertain times. Interest rate changes are a powerful tool in the RBI's arsenal. Keep a close eye on RBI announcements and analyze how their decisions on interest rates might influence market sentiment and your investment portfolio. The Indian stock market doesn't exist in isolation. It's part of a vast global network influenced by global events. A pebble tossed in the ocean creates ripples that travel far and wide. Similarly, economic events in one part of the world send waves across global markets. In 2019, trade tensions between the US and China escalated. This created uncertainty in the global economy. This uncertainty impacted investor sentiment, causing volatility in stock markets, including India's. Another example is the surge in crude oil prices. India, a major importer, is vulnerable to oil price fluctuations. Staying informed about global events is crucial for making informed investment decisions. Technical analysis is like studying the footprints left behind in the sand. It involves analyzing historical price charts and trading volumes to identify patterns and trends that might indicate where a stock is headed. Think of it as reading the language of the market, using charts and indicators to decipher its next move. Traders use a variety of tools and indicators to help them spot these patterns. Moving averages, for example, can help identify the overall trend of a stock, while indicators like the Relative Strength Index, or RSI, can signal whether a stock is overbought or oversold. When it comes to understanding the impact of economic events, technical analysis can be particularly useful. For instance, if a positive economic event occurs, like a surprise interest rate cut by the RBI, technical analysts will look for confirmation in the charts. Technical analysis isn't about predicting the future with absolute certainty. By understanding the language of charts and indicators, you can gain valuable insights into market sentiment and make more informed trading decisions. While technical analysis focuses on the charts, fundamental analysis digs deep into the core of a company. It's about understanding the intrinsic value of a business by examining its financial statements, evaluating its management team, and analyzing its competitive landscape. Think of it as assessing the true worth of a company, much like an appraiser evaluates a house. Fundamental analysts scrutinize financial metrics like earnings per share, price-to-earnings ratio, and return on equity to gauge a company's financial health and growth prospects. They also delve into qualitative factors like management quality and competitive advantages. Fundamental analysis is crucial for long-term investors. By understanding the underlying value of a company, you can identify businesses with strong fundamentals likely to deliver sustainable growth. Imagine trying to navigate a complex maze with only one eye open. You might be able to see some paths, but you'll miss out on the bigger picture. That's what it's like trying to navigate the stock market using only technical or fundamental analysis. For a comprehensive view, you need both eyes open, combining the power of both approaches. Technical analysis provides insights into market sentiment and potential trading opportunities based on historical patterns and trends. It helps you understand the when to buy or sell a stock. Fundamental analysis, on the other hand, helps you determine the what to buy or sell. It provides a framework for identifying undervalued or overvalued companies based on their intrinsic worth. By combining both approaches, you get a more holistic view of the market. This powerful synergy between technical and fundamental analysis provides a more robust framework for making informed investment decisions. It allows you to align your investment strategy with both the intrinsic value of a company and the prevailing market sentiment. The stock market is a dynamic and ever-evolving beast. But by understanding the key economic drivers, mastering the tools of technical and fundamental analysis, and staying informed about global events, you can navigate its complexities with greater confidence. Remember, knowledge is power. The more you understand about the forces shaping the market, the better equipped you'll be to make informed decisions and achieve your financial goals. Happy investing!